So you want to buy a motel, a strip of rooms, a parking lot out front, a sign with a few letters burned out. Sounds like the most straightforward real estate play there is. Rent the room, clean the room, rent it again tomorrow. But here's the number that should stop you. In 2012, Blackstone bought the entire Motel 6 chain for $1.9 billion. 13 years later, they sold it for $525 million. On paper, that looks like one of the worst trades in hotel history. Blackstone says it actually tripled their money and generated over $1 billion in profit. Both of those statements are true, and the gap between them is basically the entire economics of this business. Quick bit of history first, because it explains the whole category. The word motel is a mashup of motor and hotel, invented in the 1920s for exactly one customer, the driver who wanted to park directly outside his own door instead of walking through a lobby. The category exploded once the U.S. interstate highway system got built, starting in 1956, and Motel 6 itself is named after its original 1962 nightly rate, $6 a room, in Santa Barbara, California. For 60 years, that's been the entire value proposition. Not luxury, not service, just a clean, cheap bed within sight of the exit ramp. Which is exactly why this business scales so strangely. It's simultaneously one of the cheapest categories of real estate to build and one of the hardest to differentiate. Let's start with what it costs to get in. Option 1. The small independent motel. The kind you see off a state highway with 20 to 40 rooms. You can buy an existing one for anywhere from $500,000 to $2 million depending on the market. Mostly because you're buying the land and a building that's often decades old, not a business with much brand value. Option 2. The mid-size franchised property, 60 to 100 rooms, under a recognizable flag like Super 8 or Days Inn. Building one from scratch runs into real money fast. Limited service hotels typically price out at $50,000 to $150,000 per room, once you include land, construction, and furnishings. So, an 80-room build lands you somewhere between $4 and $12 million. Option 3. You skip individual properties entirely and buy into the machine. G6. Hospitality, the parent company of Motel 6 and Studio 6, runs close to 1,500 economy locations across the U.S. and Canada. Blackstone paid roughly $25,000 per room for the whole chain in 2012. A price analysts at the time said was actually below what it would cost to build the rooms from scratch. And Blackstone isn't the only fund that's noticed. In 2021, Blackstone teamed up with Starwood Capital to take Extended Stay America private in a deal valued at roughly $6 billion, betting on the exact same weekly stay economics we'll get to in a minute. Now here's the part that actually matters. And it's the same insight that made Blackstone's numbers work. A motel makes money two completely different ways, and most people only understand one of them. The obvious way is renting rooms. Every night you're solving for one number, RevPAR, revenue per available room, which is just your average daily rate multiplied by your occupancy. National hotel occupancy runs around 63%, with average daily rates near $159. But economy motels sit well below that, more like $40 to $70 a night, and economy segment occupancy has actually been sliding, down to around 54% in some recent readings. That's the business everyone assumes you're in, selling a clean bed for a night. The second way, the one that actually built Blackstone's profit, is converting the real estate into a fee-generating brand. Once Motel 6 became an asset-light franchise operation, Blackstone wasn't just collecting room revenue anymore. It was collecting a royalty, typically 9 to 12% of gross room revenue, from every franchisee who wanted to fly the Motel 6 sign, plus reservation fees, plus marketing fund contributions on properties it didn't even have to fund the construction of. You get paid whether the franchisee's motel is full or half empty, because the fee is baked into their revenue line, not your capital risk. That's the entire private equity playbook in one sentence. Buy the real estate cheap, convert it into a licensing machine, then sell the real estate again once the fee stream is proven out. There's a third revenue layer most people never think about, and it's the one that gave economy motels their reputation: weekly and monthly rates. A huge share of rooms at the bottom of this market aren't rented for one night at all. They're rented by the week to construction crews, displaced families, and people who can't put together first and last on an apartment. That tenant doesn't check out after one night, doesn't need daily housekeeping, and effectively turns a hotel room into unregulated month-to-month housing at a rate per square foot that would make most landlords jealous, without a single one of the tenant protections that come with an actual lease. Then there are the fees that don't show up on the sign out front. Online travel agencies, Expedia, Booking.com, take a commission of 15 to 25% on every room they book for you. And at the economy end of the market, a huge share of bookings come through exactly those platforms, because nobody's typing a Super 8 URL from memory. Resort fees and amenity fees, a term that sounds absurd on a roadside motel with a vending machine and a pool that's been closed since March, but plenty of properties charge them anyway, because guests rarely dispute a $15 line item when they're already checked in. And there's a shadow side to this business too. In 2018, it came out that at least 6 Motel 6 locations in Washington state had been voluntarily handing over their nightly guest lists to Immigration and Customs Enforcement without a warrant on a routine, sometimes daily basis. Roughly 80,000 guests had their names, birth dates, driver's license numbers, and license plates shared. And the disclosures led to targeted questioning of guests with Latino-sounding names, with at least 9 people detained as a direct result in Washington alone. The state sued. Motel 6 settled for $12 million, on top of a separate settlement of up to $7.6 million to guests in a related case, and signed a legally binding commitment never to share guest information again without a warrant, nationwide. The company never admitted wrongdoing, but the incentive that created the practice was simple. Front desk staff facing pressure from local law enforcement found it easier to just hand over the list than to push back. And it took 2 multi-million-dollar settlements before the corporate policy actually changed. Now the cost side, because this business is far less passive than the empty room fantasy suggests. If you're buying into a franchise, expect a property improvement plan, a mandatory renovation package the brand forces on you to match its current standards, often $15,000 to $40,000 per room, which on a 60-room property can mean a check for $1 to $2 million before you've rented a single night under the new sign. Layer on the franchise royalty, the OTA commissions, a 4% annual reserve for furniture and equipment that every franchise agreement mandates whether you like it or not, and staffing, which for a motel means housekeeping, a front desk that's staffed nearly around the clock, and maintenance on rooms that take a beating from guests who, statistically, are not planning on ever coming back. None of this is expensive compared to a casino or an airport, but it adds up fast against a room that might only be generating $50 or $60 a night. Add fixed monthly overhead, property taxes, insurance, a base level of utilities and staffing you're paying whether you're at 30% occupancy or 90%, and a small independent motel can easily be carrying $30,000 to $35,000 a month before a single guest checks in. That's also why most motel purchases in this size range get financed through SBA loans rather than conventional commercial mortgages, since lenders want the government guarantee on an asset class this exposed to a single stretch of highway traffic. And here's the part that makes this a much riskier business than it looks. There's no moat. A storage facility has switching costs, a casino has a license, an airport has a monopoly on the ground underneath it. A motel has none of that. Every one of these properties sits directly on a public highway, visible to every driver, with a competitor's motel usually within sight of it. If your rooms are full, the natural response of the market is a new motel going up down the road, undercutting your rate by $10 a night until both of you are losing money. Economy hotel occupancy sliding to the mid-50s in recent readings isn't an accident. It's what happens when a segment has almost no barrier to entry, and every operator is fighting over the same highway traffic. On top of that, the cheapest, most price-sensitive travelers, the exact customer a motel depends on, are also the ones most willing to book a stranger's spare room on Airbnb instead. And the labor side hasn't gotten easier either. Federal data shows nearly 200,000 fewer people working in hotels and lodging today than before the pandemic, which means the housekeeping and front desk staff. You do find cost more than they used to on a room that's earning less than it used to. Time to pull it together and answer the actual question. How much money do you make if you do this right? 3 scenarios. Real numbers. Option 1. The small independent motel, 30 rooms, purchased for around $1.2 million. At 55% occupancy and an average rate of $65 a night, annual room revenue lands around $390,000. After OTA commissions, labor, utilities, and maintenance eating roughly 65 to 70% of that, you're netting somewhere around $120,000 a year. Payback? About 10 years, and that's before a new competitor opens across the road. Option 2. The mid-size franchised property. 80 rooms, built or converted for around $7 million, including the PIP. At a healthier 65% occupancy and a $75 average rate, annual revenue runs close to $1.6 million. After the franchise royalty, OTA fees, and full operating costs, net profit lands around $350,000 to $400,000 a year. Key payback, close to 18 years on the real estate alone. Faster if you eventually flip the property once the brand conversion has stabilized occupancy. Since a stabilized, franchised asset in a decent corridor will usually trade at a lower cap rate and therefore a higher multiple than the same rooms would fetch as an unbranded independent. Option 3. You don't buy a motel at all. You buy into the fee stream sitting above hundreds of them, the way Blackstone did. A portfolio of economy properties generating steady franchise royalties and reservation fees can be bought and sold multiple times over a decade, with each owner collecting the fee income while pushing the actual maintenance risk down onto individual franchisees. Blackstone bought the whole Motel 6 system for $1.9 billion, extracted more than $1 billion in profit over a 12-year hold, and still sold the underlying real estate for barely a quarter of what they paid for it, because that's what this business actually is, not a room for the night. A highway side collection point for people who need somewhere to sleep, and nowhere better to be, with a fee attached to every layer above it.